Welcome back to Portfolio, everyone. In this video, we're breaking down 10 dividend-paying companies you can take a look at right now if you want some safe, consistent dividend income coming into your portfolio. With the global pandemic, a lot of companies aren't able to generate any revenue, and a lot of companies are actually slashing or reducing their dividend payments. So as a dividend growth investor myself, we like companies who continually pay out that dividend even during tough times in the market and are able to continue to pay and actually grow that dividend each and every year. So when I'm investing, I like to put my money into companies that are going to continue to make that payment without risk of getting cut anytime soon. So all 10 of these companies on this list are paying out extremely safe dividends, and what I mean by that is they have a very high dividend safety score, so it's very unlikely that that dividend gets cut anytime soon. These companies have the financials to support and actually grow their dividend each and every year, and they operate in sectors of the market that allows them to continually generate revenue even during this tough time. So thank you for tuning in, everyone. I'm the Gen Z Investor. Every single day on this channel, we talk about different stocks you can buy, overall stock market performance, and any other big stock market news and headlines. So in this video, we're breaking down some of the safest dividend companies on the market. Before we do that, I'm going to take a quick preview of my portfolio. You can see here, currently at $52,065. Today was the first day we ever crossed that $52,000 mark, which is a new milestone for the portfolio, up close to $300 on the day, and overall portfolio is still down around 4% or $2,100. Nothing to worry about, as I am a long-term dividend growth investor, so I buy companies who continue to pay out cash flow to investors, and I'm not too worried about share price fluctuation on the short term. I'm here for long-term share price growth without any worry. I don't plan on selling any of my companies anytime soon. Jumping right into the list, the first dividend-paying stock we're going to take a look at is ticker symbol UNH, United Health Group, currently around $315 a share. They've done a nice job of growing their share price over the past 12 months, even during this global pandemic, up 28% on the 12-month chart. A little longer term view, they are up 160% on the past 5 years, so this company has done a great job of growing consistently over the long term. With regard to their dividend, current yield around 1.6%, and like I mentioned, they have the highest dividend safety rating possible at 99. Their dividend is very safe, and this dividend safety score is generated from the website Simply Safe Dividends. This website gives you a nice snapshot of a company's dividend perspective just to show their financial backing to determine if this company can support and grow their dividend, and they use a bunch of different metrics to determine the likelihood of that dividend being remained, growed, or even cut in the future. So companies that are ranked 99, that is the highest ranking given out on the platform, so it shows these companies have extremely high dividend safety, very unlikely that their dividend goes away anytime soon. So all 10 stocks on this list are ranked 99. I'm going to break down each and every company, and they are all operate in various sectors of the market. So UNH has a nice 1.6 starting yield, and they've done a very good job of growing that actual low yield to start out with. They've done a 17% increase in their dividend this year. So very good dividend growth. Moving on, the second stock on this list today is ticker symbol PG, Procter & Gamble. So a favorite to a lot of investors, currently around $133 a share. They've seen nice share price appreciation, up 15% on the 1-year chart. 5-year chart up 75%, so once again another company that grows nicely over the long term. They are paying out around 2.37% dividend yield currently, and they've done a nice job of continuing to grow their dividend for over 50 plus years. They are a dividend king, so this company is a slow grow cash cow company. They are not a high growth tech stock. They are paying out a higher yield than the most average tech stocks at around 2.4% right now. So even though they are somewhat of a cash cow, they aren't posting those double-digit growths each and every year, so their dividend growth is average. Last year, they grew their dividend at 5%, which is nice. It does beat inflation, so you are getting a nice raise above inflation each and every year. The third stock on our list is ticker symbol NKE, which is Nike, around $105 a share right now, up 28% on the past 12 months. Nike is another company that was actually really affected by this pandemic, but they are able to still generate revenue through their online and digital platforms. And Nike pays around a 1% yield right now, exactly at 0.93. Very safe dividend, unlikely that that dividend gets cut anytime soon. And they've grown their dividend very fast at 11% dividend growth last year. Moving on, stock number 4 on our list today we have to take a look at is another dividend king, ticker symbol HRL, Hormel Foods, around $51 a share, long-term growth of 70% over the past 5 years. So this is a dividend king that has continued to sustainably grow each and every year and return cash flow to investors for over 50 plus years. So this is a company that has proven to survive economic hardship. It's gone through numerous depressions and recessions, and this company continued to reinvest into the business and return capital and cash to shareholders. Let's take a look at their dividend, currently yielding 1.8%, of course that 99 dividend safety rating, with 11% dividend growth this year. Very nice dividend growth. They are raising their dividend at a fast rate even during this time of hardship. And one thing I want to point out with HRL, they have a very low beta of 0.46. So beta refers to how volatile the stock is compared to the overall market. So with a 0.46 beta, this company shows that it is not as volatile as the overall market. A very low beta might be a nice addition to your portfolio if you want to somewhat stabilize price performance over the long term. Holding companies with lower beta just kind of reduces the overall volatility of your portfolio as well. Moving on, stock number 5 is a utility company, ticker symbol NEE, Next Era Energy, $278 a share right now, up 31% on the 1-year chart. So you can see here, they have seen the March lows, but they have recovered back to a level similar to pre-pandemic ways. And this company, of course, is another dividend stock with an extremely safe dividend payment, around 2% yield right now, and they've done a great job of growing that dividend. A 12% dividend growth this year, which is absolutely incredible. Moving on, stock number 6 is actually a company that was able to operate and succeed during this economic shutdown and global pandemic. Costco, currently at $332 a share, 1-year chart up 24%. This is actually one of the businesses that actually saw a lot of growth during this pandemic. So Costco was able to operate and run their stores even during the 4 shutdowns in a lot of places of the world. So Costco continued to operate, had consumers bulking up on products, spending more than usual, and Costco actually reported days of revenue that were similar to Black Friday and even Christmas shopping times. So during the time of the year where usually shopping levels are down, and compared to other sectors of the market, consumers are really spending money on nothing that they don't need and only focusing on necessities right now. Costco provides those necessities to consumers. They actually saw a nice little bump in revenue during this last quarter. So this is a company that actually was able to continue to operate and generate income even during this global pandemic. With regard to their dividend, currently yielding 0.84%. Once again, another company though, even though they have a low starting yield, they've done a great job of growing their dividend at 11% this year. So double-digit dividend growth is always nice to see. With regard to beta, another low beta company. So during this times of crazy market volatility where we see days of market fluctuations 3+%, up or down, if you want to add some lower stability to your portfolio and you want to hold some lower beta companies, Costco may be another one you want to take a look at. Moving on, stock number 7 is the smallest cap company on this list today. It is ticker symbol CWT, California Water Services Group. Around $48 a share right now. They've seen beautiful long-term growth of close to 134% over the past 5 years, which is absolutely incredible. On the 1-year chart though, they are down 9.6%, which may make this a nice buying opportunity. Taking a look at their dividend, of course they have that 99 dividend safety rating, yielding 1.77% right now. They've done a good job of growing their dividend at 8% last year, but this is actually one of the smaller companies on the market. Still with a $2.4 billion market cap, is a mid-cap company, but compared to some of the other brands we took a look at today, such as Procter & Gamble or Costco, Nike, these $100+ billion companies, this is very small compared to those. So if you're looking at exposure to some smaller companies with very safe growing dividends, CWT may be one you want to take a look at. Stock number 8 on our list is Johnson & Johnson. Another dividend king, around $146 a share right now. They've seen beautiful long-term growth over the past 5 years. They're at 48%. Taking a look a little bit shorter term perspective, up 12% on the 1-year chart. So this is a company that's still trading back around pre-pandemic levels, so it may not be the perfect buying opportunity, but this is a staple in a lot of investors' portfolio that will not be going anywhere anytime soon. Johnson & Johnson owns and operates so many different healthcare products. They operate in so many different sectors of the market, and they're one of the companies working towards a vaccine for this virus, which of course, if they're able to do that, will lead to nice revenue growth over the next coming years. With regard to their dividend, currently yielding 2.75%, Another cash cow dividend king who sees a little bit slower growth each and every year, but they are consistently growing over the long term. They've seen 6% dividend growth this year, which is nice to see. And of course, another lower beta company. So once again, if you want a little stabilization in your portfolio, you want lower price volatility, Johnson & Johnson may be a stock to take a look at. Stock number 9 is a stock that actually has been hammered on the 12-month chart. Aflac, ticker symbol AFL, around $38 a share. The insurance company, if we take a look at the 1-year chart, has been hammered, down 29% over the past 12 months. The entire financial sector has been hit hard, and of course, insurance falls along with that. Huge company has been absolutely hammered. If you want to take a look for a buying opportunity and you really believe in this company long term, this may be a nice entry point when price is at this level. Nowhere near pre-pandemic level where it was trading around $53 a share, currently at 38, 52-week range on the low end. With regard to their dividend though, even though they've been hammered with regard to share price, yielding 3% per year and slow dividend growth, which isn't very attractive, but very safe dividend still. So although their dividend may be growing very slow this year because of this economic shutdown, they may not be able to maintain those high dividend growth rates. They have and are yielding 3% right now, and this is a company that may see a nice recovery. But one thing we want to point out is we've been talking about the low beta companies. This is actually a high beta stock, so there is a lot of price volatility. So if you're the type of investor that likes to buy off price swings, Aflac may be one you want to take a look at. The 10th and final stock of the safest dividend companies that you can take a look at today is ticker symbol MDT, around $100 a share. Beautiful long-term growth of up 30% over the past 5 years. 1-year chart somewhat flat, only down 1%. Not at the pre-pandemic level just yet. So if you were looking for a buying opportunity into MDT, now may be that time, right near the middle of the 52-week range. Taking a look with that dividend, yielding 2.3% right now, 8% dividend growth last year, which is great to see. And of course, this is a mega cap company with a market cap around $135 billion. So those are the 10 safest dividend yield companies you can buy right now. If you want to invest in the companies that are going to continue to pay out that dividend, even during this time of economic uncertainty, take a look at these 10 stocks. Nice, growing, consistent dividends each and every year, even during this time of financial hardship for a lot of different companies, still maintaining the highest dividend safety rating possible on Simply Safe Dividends. Thank you for tuning in, everyone. I'm the Gen Z Investor. See you in tomorrow's video.